Hit it.
It's Friday, May 20th, 2022, episode 180. I'm Patrick Serezna. Kevin is cashing in a much-needed day off, but don't fret. We have Kuppy stepping in to help me with the show. This week, we have the great privilege of having Money Talks Michael Campbell joining me to talk inflation, commodities, and more. Then Harris joins us for Kuppy's Corner and sticks around to share a box of crayons with me to talk some charts. So stick around. We got a great show. Lena, hop on. Let's start with what beer am I drinking this week?
So today you're drinking Lagunitas Brewing Company's Daytime IPA.
Yes, a daytime IPA. That caught me when I wanted to try this. Let me first try it. Hold on a second.
Well, it says here, less carbs than a banana and easier to peel. That's what it says.
That's awesome. It's got all of the great tastes of an IPA, and it's only 4%. It's I'm going to dare use the word that Kevin laughs at. It's sessionable.
Oh, I knew it was coming.
Anyway. All right, but listen, we have an update. We have to tell everyone about the Piss Up, right?
That's correct. So if you haven't heard, obviously you haven't been caught up on our Market Huddle episodes. We are having a Market Huddle Piss Up finally in Toronto. At the bottom line, it's near the Hockey Hall of Fame. The address, I believe, is 22 Front Street West. It starts right at 4:30, right after market close. We are going to foot the bill for the first 200 pints. Unfortunately, they don't do pitchers. So 200 pints.
Exactly.
So if you show up late and we've already run out of 200 pints, you're on your own. So
we had to go through a whole project to figure out how many. We had to convert pitchers to pints and do the calculations to add up what is the right amount to settle the debts that we have outstanding, because there was no netting and we had to make sure we cleaned the slate. But 200 pints, for the first ones there who drink it, it's theirs. Otherwise, you're on your own on that.
Yeah, so if you snooze, you lose. So this is on Wednesday, June 1st at 4:30.
All right. And Lena, can you give us a disclaimer?
Sure. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include analyst bleeding, analyst fissures, and analyst leakage. This is from a listener, Andrew, after listening to Dario Perkins' episode.
Analyst leakage. We don't want to suffer from that. Okay, let's get to our interview with Michael. So joining me today is the host of Money Talks, Michael Campbell. Welcome to the show.
My pleasure to be here.
Now, Michael, we've known each other and collaborated together for almost a decade, so it's a real pleasure to have you on. I want to talk markets and economy with you, but before we do, I wanted to spend a little bit of time talking a little bit about your backstory. So the question we usually like to start with is, where did you go to school, and at what stage did you figure out that you wanted to get into economics and investing?
I started at Carleton University, moved to the University of British Columbia, then did graduate work at the University of Sussex. And it's at that point that I realized you couldn't understand. And I was interested in economics. And I was interested, though, in why some countries develop and others don't. Why are some countries being held back? And at that point, we're talking a long time ago, I'm sort of laughing, we're talking in the 1970s here, that was a very hot topic at that point. That, when we looked at, why is Southeast Asia starting to move? Later on, we would have asked, why is China starting to move? And why are other aspects areas like in Africa, too many African nations are not moving forward? So that's when I first started to get really interested in economics. And from there, it went to, I felt I couldn't understand economics if I didn't understand capital investment and if I didn't understand taxation. I thought those are two, major components when you're talking about the growth of an economy. So that's basically where I kind of got interested in that stuff. And from there, I went and worked for Merrill Lynch in New York, and I got to work with the great Bob Farrell. I was a cub. I was a student. He was working with a lot of people. It was just more I got exposed to his work in technical analysis with Bob Farrell. Moved back to Vancouver, which was my hometown, and always had that intention, and worked in the investment business in Vancouver. and moved out of that. To be honest, I got tired of handling people's emotions. I just felt the irrationality didn't work for me. And I started to spend a lot more time writing about investments. I started several of my own businesses that, with luck, seem to do pretty well. I got into broadcasting right around those same times. I mean, I have been broadcasting off the top of my head since 1980. I started on a national radio station in Canada and moved on to what's now called the Chorus Network in Canada, did a lot of TV work, all of that kind of stuff. So yes, it's a real passion of mine. I always thought it was convenient to get paid for something I'd be doing anyways, which was research.
Well, that's great. Yeah, your radio show, Money Talks, has been on the air for decades and is certainly, at least in Western Canada, a must listen to for many, many years. And you also started some Outlook conferences out there in Vancouver, right?
Yeah, we did. We started to do these major conferences, and again, my goal was to expose people to sort of top-notch research and top-notch individuals, and usually independent, sometimes not. I mean, sometimes they might work for a mutual fund, et cetera. And the audience had to understand that. And we're still doing them, and they're still very popular. The track record is all I care about, and which has been exceptional. Because if you get good people involved, it's no different than doing the huddle. If you bring on good people, and you do lots of good people here, that there's something exciting about bringing and upping the level of discussion, upping the level of conversation, exposing individuals to some expertise and some thought processes that maybe they wouldn't otherwise. So I think that's why the conference has done well. But in this business, the bottom line, it comes down to what's your track record. And so the track record has been very good thanks to engaging with so many good individuals. And so, yes, and I still enjoy that very much, is from the range from introducing people to certain personal financial aspects to broader kind of macro trends that will influence their lives. And of course, we couldn't get a better environment than right now to discuss things.
Well, you're talking about Vancouver, a city I love very much. And one of the things, obviously, inflation has become a story recently over the last couple of years. But Vancouver real estate, well, that's where inflation has existed for a decade or more. And I'd love to just get some of your insights on what's going on currently in the Vancouver real estate. And what do you think are some of the really interesting things about it that people should be paying attention to in the years going forward?
Well, one of the things I was thankful for with the Vancouver real estate market is, of course, it moved dramatically, especially at the upper end of the market. And what it was is it made it much easier for me to describe that international events have an impact domestically. There's a tendency even still for a lot of people who discuss these things to think about what the domestic situation is like. But in Vancouver, that was easier because you could ask anyone. You say, well, what are some of the drivers of our market out here? And people understood that it was a lot of money coming out of Asia, especially China, into our marketplace. So that was a wonderful example, years ago, that the international factors had a place. The second thing that it described, and I remember reading all these things about how unaffordable Vancouver was becoming, and commenting, you say, well, you're not getting it. This is all about safety. And people wanted their money out of China, and they wanted to have it in a different location. And so obviously Sydney benefited, Singapore benefited, San Francisco benefited. There's other examples, but Vancouver was a major beneficiary of capital seeking safety. And I think that's one of the fundamentals on the macro side of what drives investments is what's the capital flow doing? One of the main impetuses for capital flow is for safety. And so Vancouver real estate was like one of those huge beneficiaries of it. And one of the big stories that's kind of interesting out of it, and there's been a lot more research done recently. Someone named Sam Cooper's written a wonderful book called Willful Blindness, and that's how the Vancouver upper end real estate market became a parking place for organized crime. And a lot of that coming out of Asia too, that very lax rules or naive rules or however we want to phrase it. But we also got a lot of organized crime parking the money into the Vancouver real estate market, which proved to be obviously a good investment for them. And here's the thing that's changed, though. This is this week. Xi Jinping came out this week and said that he's insisting that all upper echelon members of the Communist Party of China, the government of China, must divest themselves of foreign assets. And that included their wife and children. Because we saw that phenomena in Vancouver, where somebody's wife or their child with no visible means of income would buy these luxury houses. I'm talking in the $3, $4,
Right.
$5, $6 million range. Well, this could be this is something to keep your eye on, because he has come out very clearly. The president, Xi Jinping, has come out very clearly and said, and I think he's looking at the Russian sanctions. I think they're looking at maybe going into they are going into Taiwan. He's promised that. It's just he's now used Russia as an example of what would be the repercussions in terms of sanctions, et cetera. Well, one of the things, of course, is the sanctions on individuals. He doesn't want to be vulnerable that way. So yes, this on, I think it was Thursday this past week, that he came out and said, those kind of foreign assets have to be disposed of. Well, some of that's real estate in Vancouver, I'll tell you. So it's going to be very interesting how that translates later.
Do you think, though, that that's going to be just more taking new money flow out, or do you actually think that could put some downwards pressure actually on real estate there?
Well, Xi Jinping said he wants them to divest. So they're talking about selling. And, if the Communist Party of China is making a public pronouncement, I wouldn't run afoul of them. And especially, I say, there's a bigger picture there, I think, in operation that, how many stories have we heard about the oligarchs getting in Russia, having their assets confiscated, the pressure that may have put on Putin's government, et cetera. So I think that's I'm making a guess because this is brand new. It's within 48 hours. I'm making a guess that specifically is what he's looking at. And so I would suspect it would put downward pressure on the market at this point. Plus, of course, there's been a stepped up kind of at least attention played to some of the illegal money that's come into Vancouver, and laundering it through our real estate market there. So I think that's also, and then you combine that with higher interest rates, with a change in psychology. So yeah, I think it could have an impact, especially because it's focused on the upper end of the market, which isn't near as big, and we're talking about, because what good does it do you to move your money out of a country for looking for safety, and it's $33,000, if it's a cheap home or something. So it did concentrate at the upper end.
All right. Well, if we're on the topic of rising prices and things like that, we should talk about inflation. I mean, the hottest topic out there. And I want to let's actually start off with this question of simply, do you believe that inflation is secular and here to stay, or is this going to be something that we're going to see mean revert considerably in the year to come?
Well, I think one of the big things around that is that keep in mind that this time next year, so we get to May 2023, we'll be comparing energy prices, for example, or diesel prices or gasoline prices to what was happening this year. So your baseline has gone so much higher, or wheat prices or corn prices. So the government's going to be able to play a little bit of a trick there, and they're going to say, well, inflation's only up 2.5% or something. That's why it'll go down. It'll go down because, of course, that we have, we're comparing it to a much higher base number when you compare it year to year. So that's the first thing. Second thing, obviously, inflation, I couldn't agree more, but the central banks can only go after demand. They're not changing what's happening in the food market. They're not changing what's happening in the energy market. And those are the two things that I think are revolutionary in nature for the public. Because you raise food prices, and you start making a problem there, as we saw it in Tiananmen Square, by the way, in '89. That was the impetus, or the Arab Spring. But we're seeing it right now in Sri Lanka, in Peru, other countries where you're seeing literally food riots. I mean, in Sri Lanka, they've burnt down 38 politicians' houses. I mean, wow. Starving people is not a good idea, and I don't see that being alleviated going forward particularly. And there's a lot of factors we can get into. And the energy side isn't going to change. I mean, it's a structural problem. If we do get a global slowdown, sure, that will sort of have a little dip in prices, but we still have that fundamental problem of increasing demand, especially coming out of emerging markets, some of it coming out of increased, sort of the restrictions of the pandemic being released. But who in the heck in the right mind wants to invest in fossil fuels? I mean, we've already been told that they're on their way out, and some of them with unrealistic timeframes, by the way. It's not going to be on their way out, and that's why prices are up by 2030 or 35. But the point is, who's going to invest in those things? It's been such a negative kind of attitude from government. So your energy prices are going to stay up. Your fertilizer costs are going to stay up. So all they really can do is look at demand. And that'll slow down. And yes, maybe some of the supply issues will lighten up. China is opening up a little bit more. But the bottom line is they can only do so much on the inflation front. So their big rescue is going to be that they're going to be comparing it to much higher prices.
Well, Michael, I do want to ask you. I mean, you're a seasoned trader or investor with a long history. Like you were saying, from going to school in the 70s, you saw inflation during the 70s. And now the question I have for you is, how does this current inflation cycle compare to the 1970s cycle? And how do you approach investing in that kind of environment?
Well, we certainly had an energy problem in the 1970s, so there's a little similarity there. But think about what we're coming out of here. I mean, we have not had a cycle that was been produced by the amount of money flushed into this system. I mean, I know the word's so overused, but it happens to be accurate. It's unprecedented. When the U.S. floods their system with $5 trillion, if Canadian listeners know that the government spent spent or has plans already in the books to spend $576 billion over just a couple of years. I mean, this kind of money coming into the system in combination with record low interest rates, we've never seen anything to this degree. And I know people will go back to the 1940s, and I think there's some valid comparisons there. But at the same time, I think it's the degree to which it's just been, Milton Friedman made it clear, and this is the big debate, but he said, everywhere and always, it's a monetary phenomenon. Well, we have certainly pumped money into our system at a level that I think is unprecedented.
Well, let's talk the Fed, because the Fed is clearly kind of recognizing that they did flood the system, and they're now trying to slow the demand side of this and raise rates, and they're clearly in this monetary tightening cycle. How do you think this plays out? How many rate hikes do you think the Fed will be able to get in, and how does the rest of the year play out in terms of the Fed policy?
Well, if you look at the markets, they're telling us almost 100% that you're going to get that half point coming up in June, a half point in July. From there is where you start getting some disagreement. How many more hikes there are going to be, from that point. In fact, in the market, you're still seeing, I think, about 25%, 35% actually, of market analysts saying there's going to be 12 hikes. My goodness. And we've had, keep in mind, we've already had the first few there, and the other two promised. So, yeah, I think we're looking at still, the market is anticipating, at least to some degree, there's people out there saying there's still going to be many more hikes. The real debate is this, though. I think they've underestimated the degree to which the market psychology has changed. I mean, you had the former head of the New York Federal Reserve, Bill Dudley, saying their goal is clear. They want to sort of eliminate that wealth effect. When people's housing is going up or their stocks are going up, they feel pretty good about stuff, so they go out and spend. I think they're going to be shocked how fast that's unraveled. You're already seeing the impact on the U.S. housing market with the April sales down, but you've watched huge jumps, with the market anticipating the rate increases. So you've seen huge jump in the 30-year mortgage, which is about 90% plus of mortgages out there in the States. So we've already seen that decline. But, I love looking inside that market, because the comparison I have is looking back in 1987. And it was my first real experience with what happens when people are sort of panicked and liquidating positions. And that's what I think I've seen here, that everything's gone down. Why? Because they're raising cash. Some people, we don't know completely the internals of the market, but we do know that there's been an unbelievable amount of money borrowed on margin to be in the stock market. We know that was the case in the crypto space, tons of amount of money. So I don't think the Federal Reserve, or the Bank of Canada for that matter, can anticipate how fast that psychology is changing. And we saw the crypto fallout. We've seen various estimates of how much money's been lost in the equity markets, whether the number globally is 20, I've seen between 23 and 35 trillion. These things have an immediate impact. I think the psychology has changed from my anecdotal view, that people don't feel as good about things. So I think the slowdown can come even faster, which of course is why the Fed won't be able to raise 12 times. I think that's, the big debate is how much can they raise without killing the economy? Well, I think we're already seeing signs in the housing market. I think we saw signs in the retail market with Walmart and Target this past week. I think it was quite surprising to the degree their sales had slumped. So that's the big debate. I just think the impact of what they've been doing, especially because they haven't anticipated the change in psychology thanks to the credit unraveling, isn't going to allow them to raise as often as the market's suggesting at this point.
Well, let's just touch on the stock market. The one thing that's kind of surprised me was that, a lot of people obviously feeling a lot of pain, but the selling seems to be very methodical. It's like it's just down every single day. And in the past, we've often seen more liquidity events where things almost crash down. And this is like an orderly distribution, it almost feels like. And it seems like it's just relentless every single day. And, while the correction is, the markets are 20-30% off their highs, we're still just at the same price we were in March 2021. Just a year ago, we were trading at this price. And this is not, a crazy deep correction yet. Do you think that this has more downside? And more importantly, where is the Fed put? Like, how low can it go before you see that the Fed says we've gone too far and we have to kind of, change policy here to calm everyone down?
Well, I think the correction, though, started a long time ago, like maybe back in August. And I mean, like I was just going to say, we should phone a couple of the Peloton owners, the shareholders, and ask them if they think it's going down further, because they're off 90%, and it was really interesting. And of course, there's been so much publicity about how far down ARK has gone. And, but you look inside some of these, the high flyers or the poster children for the rising market who aren't necessarily reflected in the Dow Jones index, at least. And they've had a tremendous decline. I mean, I did a thing on Rivian when it came out in November, and, the remarkable jump it made. Oh, presto, now it's down, I think, 88%. I mean, we have to check the market every 15 seconds to see if it's down more, or any of these companies. So we have had a huge correction in just a real swath of sort of the innovative tech that's, been up and coming, grabbed a lot of the headlines. So on that side, how could there be much more to come unless they're going into bankruptcy? See a huge correction in the marijuana side, which actually has surprised me to the degree to which, given we've got lots of talk about legalization still out there, man, have they ever taken a beating from the frothy side on the way up. And so we do have these categories of stocks that have really taken a beating. Where I look at the liquidity side of it is stocks that sort of don't have a strong reason to go down. And commodities comes to mind. I mean, we haven't had a huge correction, certainly not in oil, but in a variety of other commodities they've had sort of a softening thanks to China's lockdown, probably demand sort of easing. But the stocks have been a lot further. Gold would be an example. Gold bullion hasn't fallen that far, but a lot of the stocks have taken a much bigger hit. Sometimes I think that might be people just raising cash on that side of the category. But I mean, I look at the, right now, when you look at the price earnings ratios for the S&P, well, it's back to the 20-year average. So there, you could make an argument, but maybe we're sort of sussing that out. But if you're asking me as an investor, I think I'm risk averse at this point. I still am worried about what's to come.
Right. And one of the things that obviously has been a byproduct of this tightening cycle and the way that the inner markets have developed has been an incredibly strong U.S. dollar. And the U.S. dollar has been moving almost against all cross currencies, including the commodity-based ones. How long do you think this, and how much more do you think this dollar has? Do you think that this is a new bull market in a dollar that can still keep going, or is this almost run its course?
Well, I think it's all about safety. Historically, when people get nervous, they move their money to the U.S. dollar. I mean, they can't move their money to Canada or New Zealand or Australia. They're too small. So to me, it's all been about the level of uncertainty that's out there, primarily in Europe, because look at what's happened in the euro. And I think these trends are still in place. I mean, I thought shorting the euro was one of the easiest, and you should always be careful using that word. That's how you get it handed to you later because you've been mistaken. But I did have a lot of confidence at every time the euro was up. I mean, I'm talking from years ago and continuing the bounce it had, going back several months, 124 or something. I thought this is one of the easiest shorts on the market. I mean, the European Union is a mess. Now you add on the invasion, obviously creating more uncertainty. So presto, not a big surprise that money moved into the U.S. and pushed the U.S. dollar up. That's what I think it's all about. It's all about that level of safety. So the US dollar can absorb that much capital coming in where a lot of other markets can't. I always look at, okay, what was your other choice if in fact you did have this worry and you were worried about all sorts of geopolitical events, for example? Well, the euro wasn't much of an alternative. The Japanese yen wasn't an alternative and the British pound wasn't an alternative. It's sort of somewhat by default, but historically that has clearly been the case. That when there's a level of uncertainty, the U.S. dollar is the tallest dwarf, so it benefits from that. So to me, and also you're looking at the discrepancy in interest rates now, where you have the Federal Reserve pushing rates up and the market going way further ahead of what the Fed's already done. They're anticipating. Well, compare that with Europe. Compare that with Japan. Japan's working so hard to keep their rates down. So on a comparative basis, the U.S. looks more attractive on that. It looks more attractive than Canada, too, although the capital flow out of Canada wouldn't be that big a deal. But certainly in Europe, the U.S. looks much more attractive on just a rate base and a safety basis. So I think those are the dynamics behind the move. And I think there's probably still more to come.
All right, so let's move on to a topic that's near and dear to both of our hearts. We're both Canadian investors, so by default, we own lots of commodities. And so let's talk some commodity stocks and the commodities themselves. And we got to start with the big boy in the room, which is oil. And obviously, you were alluding to the idea that there were supply issues all along in the oil market, but then came along geopolitics in Ukraine, throwing all sorts of monkey wrenches into the gears. What's your take on the oil market, and what do you think is in store for us still in the future?
Well, as I said, you make the distinction between short term and longer term. The longer term is all structural. The short term may be that we have a recession globally, coming up in the next year or so, a year out or something like that. And that can certainly dip the prices down. But there's no way that oil is going to be able to meet demand, that the production is going to be able to meet demand. And Canada is well positioned on that, especially for shareholders. I mean, we know the trend. It's well outlined there that companies are not expending their capital on increasing production. They're expending it on increasing dividends and share buybacks. I mean, that's a pretty constant trend. That's good news for investors. So yes, on Money Talks, we've been very clear on the commodities since February 2020. We said the coming bull market at a major conference we ran. And since the fall of that same year, 2020, we said you got to get on board the oil wagon. And that's because here's the other side that doesn't get regularly factored in enough, I think, which is demand coming out of emerging markets. I don't know if it's elitism or Western bias, but come on, you are not going to hold back India. You're not going to hold back Africa as it emerges. And this is the longer term trend. And this is the structural problem we have, is that capital investment, I think quite sensibly, doesn't want to go into more capital investment to increase production. I mean, why would they? You still have governments that are anti-fossil fuels. I mean, look at Germany. They've learned nothing. They're still decommissioning their nuclear power over there, forcing their reliance on Russian gas at this point, and oil and coal. But I think Prime Minister Modi in India made it very clear after COP26, which was sort of an elitist fest, that, hey, we're not going to sign on to this thing. We need our standard of living to increase. China has the same goal. And so you've seen increases in coal production, coal commitment. Well, fossil fuels are going to be with us for a while. I mean, the idea that we could have transitioned off them by 2030 I don't have an adjective to describe how I feel about the absurdity of that. It just wasn't going to happen. And they talked about peak demand, but that didn't mean reduced demand. But the problem we have right now is it's not easy to increase production. Who are your willing partners in that from the private sector? We know, for example, I looked at the April numbers for OPEC. 8 out of the 10 that OPEC was measuring were under their own production quotas already. So we've got a supply problem that I think makes perfect sense, that we've discouraged capital investment. We've vilified the product. Well, but we have rising demand. And yes, rising demand because of course, COVID restrictions being lifted. But the longer term structural one is emerging markets. And that's not going away. So yeah, I'm very optimistic about oil companies. They're making a ton of money right now, as we know. But I don't see a reason structurally for that to change. So I love the Canadian oils, for example.
Right. And you've also always been, well spoken in terms of discussing the Keystone Pipeline scenario. And I noticed a tweet out that you were commenting about the Keystone Pipeline and then commenting on the fact that U.S. was looking at loosening sanctions against Venezuela. And I just wanted you to share your thoughts.
Well, I think it's an absurdity. Think about when that first happened. We got reports going back about 2 months ago that the State Department had sent officials to Venezuela. Obviously, they're trying to do a deal with Iran to increase production, but they weren't going to Canada. There's something so wrong with that picture that Biden gets 1 month or 1 week into office, and the first day, basically, he cancels Keystone XL. And yet they're willing to go to Nicolas Maduro, who is a human rights abuser, right at the top of the list, along with Xi Jinping and a few others, willing to go to Iran for their oil supply. It's crazy. The one thing for Canadians, by the way, that they have to be aware of is that Venezuela has an easier access to the refineries in the Gulf, and they serve up heavy oil. That's what Canada's sending down to the Gulf is heavy oil. So I think they'll get a competitive price advantage at this point if all the sanctions are lifted. But the demand is certainly going to be there. It's great news for the Maduro regime. They haven't had to make any concessions whatsoever. To me, it's one of the great travesties or reflections of such horrendous energy policy driven by ideologues. As maybe, of course, surpassed by Germany's reliance on Russia, despite 4 or 5 years of warnings. But yeah, I think there's huge issues there but in Canada, it's got the same problem though, is who would invest in more production in Canada when you've got a federal government that spent 6 years denigrating fossil fuels, promising that we were getting off fossil fuels in Canada. Of course, you've got a huge anti-infrastructure contingent in the country that gets plenty of play, against pipelines, for example. And we have the other issue that we haven't discussed is the real problem right now is a refining capacity. That, I sort of surprised some people the other day, Patrick, when I said, you've never bought crude oil. They hadn't thought about it. I said, the crude oil price isn't your issue. It's the refined price of maybe diesel. It might be propane and obviously gasoline. And we have a refining capacity problem in the US, in Europe, and in Canada. And again, I can speak to Canada directly is who the heck would want to build one with the regulatory burden that you get, the expense that comes with it? Would it ever get built? Well, the answer, I think, for investors is I'm not taking that chance. So that's the energy background for us, that right now, on the East Coast, diesel shortages are at least being rumored. Obviously, record prices in the U.S. for diesel and for gasoline. And a lot of that just comes right back. It isn't that the oil price has changed, particularly in the last 2 months, but refining capacity isn't there.
Right. And when we're talking energy, we have to touch on uranium because that's been quietly a very hot topic. What's your thinking on uranium?
I'm bullish on uranium. I think the current market dip gives an opportunity. You look at what Sprott's done by, their uranium fund. You can get a hold of the uranium itself. Obviously, there's not a lot of producers out there. It's pretty easy to identify your blue chips like Cameco. But I think that nuclear has to play a much larger role. And I'm not talking about my opinion. I'm making an observation that, keep in mind, while the media maybe didn't report the degree to which there is a huge debate aggressive debate within the environmental climate change movement itself about the role that uranium can play. And the quote that comes to mind is James Hansen. He was the guy behind Al Gore's Inconvenient Truth. I mean, his climate change bona fides is unassailable. And he says the idea that renewable energies can replace fossil fuels is grotesque. And of course, now we're just starting to get a better understanding, or at least the public is, maybe it's the media first, of the level of mineral exploration that will be required to produce a single battery, whether it's lithium or you're talking about EVs, you're talking about copper, you're talking about nickel. I mean, there's been this huge disconnect. It's sort of like saying, hey, you know what? I'm going to build a house. Where are you going to get the materials? Oh, we don't know. There isn't any. I mean, it's just not been a realistic conversation whatsoever. But so I think the whole nuclear power issue is gaining momentum. You're seeing several countries, I'm thinking off the top of my head, UK and France and China and India, all initiating new projects for nuclear energy. France already is, of course, gets the majority of their electricity from nuclear. I think that's the momentum because it's zero. I mean, modern day nuclear power plants are efficient, safe, effective, and no emissions. So I think they're the ones at this point are going to have their opportunity and their growth. And we're seeing it, as I say, in the countries I just outlined. Well, where are you going to get the uranium? I mean, that's another industry that didn't increase its production. It's so manageable to understand we don't have enough supply. There's only a few blue chips involved with uranium. So, yeah, I'm bullish on uranium a longer term. I'm not talking about as a trader.
Right. And so, I want to, though, touch on basic materials because clearly, like you were alluding to, is the fact that the Fed is tightening monetary policy and slowing the economy, and it could result in a recession a year down the road. And the thing is that typically basic materials are cyclical in terms of these types of periods, but yet overall, commodities have been in such a strong bull market. Do you think that a recession, a risk of a recession, is something that general investors in basic materials should be concerned about?
And you said the word investor. So traders, of course, are looking at much shorter term timeframes. But as an investor, the fundamentals that are driving it, underinvestment for 7 years. I mentioned oil, but you could say the same thing about copper as an example. And I think it really will come down to, are we serious about pursuing renewables and that sort of energy transition or not? I think it's difficult to make the argument we're not. I mean, even though there's practical obstacles, they are going to go forward with it. And listen to the talk out of Europe right now, who's being punished for their past policies, obviously in forms of higher prices, yet they're still talking the same game, So I think that alone is going to be sort of a floor underneath the demand. And also keep in mind, I mean, it's not like I could all of a sudden get a copper mine up and running in 3 years. So there's a long-term demand that's not going to be supplied. It takes years to build out. I think that's those industries and those main metals. Yes, we could get some technological substitution, but there's nothing on the horizon right now. There's a lot of work being done on batteries. So maybe the demand for lithium isn't 1,000 times more than it is today. But I don't see any substitutions for copper in here being rumored or worked on, or nickel, or those kinds of cobalt, that kind of stuff. So, and let alone if you're talking oil, the 5,000 products or so that are made from oil. So I don't see the substitution, and I see the drive politically. I don't see how that drive toward renewable and the transition gets derailed at this point. I mean, despite what we've seen in the energy market, that seems to have even fueled it more. Oh, look at the president of the United States saying, "Oh, you don't like high gas prices? Well, for goodness sakes, buy an electric one." Electric car. So I think there's a built-in demand coming that we cannot supply at this point. So, yeah, I'm still positive on that.
All right. Well, we can't finish talking about commodities without touching on precious metals. What's your take on the gold and silver here? First of all, how they behaved over the last half a year, and what do you think is in store moving forward? Are you bullish here?
Yeah, well, let me ask a quick question. If you were sitting in Venezuela, or if you're sitting in Argentina, or if you've been in Turkey, you think we have had a bull market like you can't believe, like historical, unprecedented, explosive bull market in gold. So the fact that we measure it in US dollar terms has to be taken into account. And that reflects this, is I know that there's a lot of people, and they'd probably say that guy doesn't know what he's talking about. I think it's clear that gold does not react to inflation. That's not the issue. The issue is declining confidence in the currency. If you want a big move in gold, wait till that happens. So we've already seen it. I mean, if we had enough time, I could go through 60, 70 countries that have had major devaluations of their currencies. So hence for them, every commodity's gone up, including gold, including silver. So we talk about it in US dollar terms only. So then the question becomes, at what point does confidence, and I think this is the number one investment question, is we've watched and our modeling showed us that we would think that all the problems with sovereign debt, for example, and other problems would manifest in emerging markets first. Well, we're seeing that. We've seen it. Huge inflation rates as confidence declines. Okay, then when does it come to Europe? Well, I think we're also seeing that. Look at their producer price index up 33% announced, I think it was on Friday. 33%. That was the highest since they ever kept records. That's going to translate into more inflation. And I know there's other reasons like the sanctions pushing energy prices up. But part of it is what's happening with their currency and their purchasing power. I just see that if you are a bull on gold, and I think people should have some gold as a nice kind of safekeeping kind of thing. I'm not looking at it to outperform. I think that's fine, but it's not going to be driven by inflation. It'll only be the type of inflation that's really driven by my paper currency can't buy anything. That's what will drive it. And so I'm not surprised that it hasn't done much. I'm not surprised. I'm surprised that silver got to $19. That I didn't think it would get quite that low. I think for people who are accumulating, those are the kind of numbers, and something right up your alley, Patrick. If people are a little nervous for further decline, then simply sell a put on one of the exchange traded funds at first. If you want to get your toe, and get another sort of 10 or 20% discount. But yeah, I like silver longer term. I do like gold, but the reason on gold is because I see this whole thing about declining confidence in government is a trend that is gaining momentum, not being reduced.
All right, Michael. Well, it's time for me to pull out a couple questions Kevin loves to use on his feature interviews, and I'd love to just ask them to you. The first one he likes to ask is, what is your favorite investment book and why?
I think it's Jim Dines, who recently passed away, and it was Mass Psychology. And Jim was one of the pioneers in technical analysis, and he really was a legend in the markets. But his analysis of how people's psychology really creates their success or failure, and some of his lines coming out of that, like gambler's secret desire to lose, I thought were just fascinating. And when he wrote that book, it was truly a pioneering book. And I think so that was one that I found was influential. There's many, but I would still recommend that book to people.
Right. So another question for you is, are great traders or investors born or made?
I think the first thing, I think you have to have the psychology or the makeup to be a trader. I recognized in myself years ago that I wasn't. And it's interesting to sort of, when I dig into that, I go, why? Well, I was brought up by a single mom. That, losing money didn't feel very good to me. And so I really recognized that I didn't have that sort of emotional makeup to be a good trader. And so I think a lot of that is basically born. Then you learn the rules after that. And the key, there's a guy named Dan Millman who wrote a book years ago called The Peaceful Warrior. But I loved one of the things he said in it. And he says, there's only 7 great lessons in the universe. The question is, how often do you have to learn them? Well, I immediately put that into the investment markets. And over time, I've been shocked how often I have had to learn them. But I thought that was really important. So I think you first of all have to have the disposition, that emotional makeup to be a trader. Then from there, it becomes learned. It becomes learning the rules, learning your own risk management system. And anybody who's been in the business long enough will certainly have created something that works for them. And we both know what a huge variety there is. I mean, people looking so many different variables that have worked for them. So I think there's a huge aspect that is learned, but I think you do start, as Bernard Baruch, I think, famously said, if you don't know who you are, the markets are a very expensive place to find out. And so I think there's both components.
All right. Well, on the Market Huddle, we have a very large amount of young listeners, and just wanted a lot of people just starting off in the business. So what advice would a veteran like yourself give to young people that are just getting into this financial business?
I think it's one that so many people would offer, which is it's all about risk management. You don't make your money because you spotted something good, that ship was going out. No, you make your money because you learn how to risk manage. And people are learning this right this second, is how painful the losses are. And it's very tough to recover from major losses. So if you did own, Peloton, you had $100 in it and now got $10. Well, you need that thing to go up 10 times from here to break even. Well, that's not doable too often. And so the management of risk, it may not be as sexy and as attractive, but you talk to any pro who's been successful and they'll talk to you about their risk management system. So that's what you're identifying right away. And it can be as simple as starting with saying, what's an appropriate amount of money for me to be risking on this? I remember asking many of the classes I taught years ago at university, and I would ask them, who thinks they're a very big gambler? And no one would put their hand up. I said, none of you have ever bought a lottery ticket? Well, they all put their hands up. And I said, well, yeah, you can gamble, but you've got to manage the amount of money that's there. And I think all of those techniques are so valuable. And really, in the end, it's going to spell whether you're a winner or a loser over time. And that's managing risk.
All right, so we'll wrap it up with one more question. It's the Don Cox investment questions. What do you, when you're looking at newspaper and you're looking currently on that story on page 16, which is the story that is on its way to page 1?
Well, of course, one of the big things if you're in politics is to not be accountable for anything that's happened. I mean, I've been laughing at the States of every month there seems to be a different reason why we have inflation, whether it's, I think this past month in May, it's been President Biden said it's because greedy corporations don't pay their taxes, but go back a month and it was Putin, and go back just before that and it was, supply chains. The list went on because they don't want to be accountable. And in the same way, this is the story that I think should be on the front page. And that is our policies regarding energy have produced this huge jump in natural gas prices. We've seen it in Europe, and we started well before the Ukraine invasion. Well, I can't believe that we have people making policy who don't understand principal component of nitrogen-based fertilizer is ammonia and urea, both coming out of natural gas. So when those prices went through the roof, well, so did ammonia. I wish I had bought nothing but ammonia last year. It was at one point I was looking at it was up 600%. Well, fertilizer costs have gone through the roof. And as I say, you can't use Ukraine invasion as an excuse. We were getting warning from major manufacturers in Europe that fertilizer crisis were going to force a huge food crisis. Why? Because they're unaffordable. In North America, you've watched fertilizer go up, depending on the type, but you're still looking at a double in the last year. It could be much higher, depending, because you get a potash-based, et cetera. Well, what happens then is two things. Is we might substitute a crop that isn't so fertilizer dependent. So that'll be one thing. But really the problem is this. We got 193 million people estimated who are right on the edge of starvation in this world. Well, believe me, when you add on the Ukraine sanctions, for corn and wheat, but it's on top of the fertilizer problem that we have that they cannot afford in many emerging nations. They can't afford the fertilizer anymore. And we have tons of evidence of that. We are literally made some choices in terms of energy policy that produce mass starvation. And that's why you're seeing the food riots that I alluded to earlier. You're seeing them in Sri Lanka. You're seeing them in Peru. You're seeing them in at least a dozen other countries. Well, it gets worse than that. So I think that's one I wish was on the front page because it's so serious going over the next couple of years.
Well, yeah, I couldn't agree with you more. It's certainly going to be a crisis in the making, and hopefully we find a way to persevere through it all over the longer term. Anyway, Michael, it's been great to have you on the show, and thank you for taking the time to join us. Can you share with listeners where they can find you?
Yeah, it's pretty straightforward. It's Mike's Money Talks, mikesmoneytalks.ca, because from there you can get on our Twitter account. And I post stuff. My goal on Twitter is to post things that you're not seeing in the mainstream media, is to maybe grab a stat, maybe grab a story, maybe grab a point of view, because I found the conformity of the mainstream media more than distressing, especially, and it seems to be increasing. So you can just go to mikesmoneytalks.ca. You can listen to the podcast that we release every Saturday. And as I say, on mikesmoneytalks.ca, you can then spread out and go to Facebook, go to Twitter, etc. And I'll finish with this and just saying, you and Kevin do a great job, really after my own mind, in that you bring a ton of really interesting perspectives, quality research, and quality advice. And you make it a lot more fun than I do, by the way. And I'm a fun guy.
Well, you know what? You've been one of the ones that pioneered all of this. So, it was such a pleasure to have you on.
Thanks very much.
Well, thanks, Michael, and have a great weekend. All right, it's time for Kuppy's Corner. Harris, how you been, buddy?
I'm doing great. How you been?
Oh, I'm doing great. I'm going solo without Kevin, but I really appreciate the fact that you're going to stick around and talk some charts with me afterwards. I'll share the crayon box with you, buddy.
It's been a while since I dug into the crayons. You can make me look like a fool.
Anyway, so listen, we have so much to talk about. Man, is it a crazy market. But before we get into all of your favorite topics, I remember you coming on the show like a year ago saying, you're long Bitcoin, but never once, even when you were owning Bitcoin and all the other cryptos, you never once stopped calling it a Ponzi scheme. And it's like you knew all along that this was coming. You just figured you were going to make a little bit of money along the way. But here is Crypto Armageddon. Like, what's your take on all of this?
It's fucked. I don't know. They're having a run on the bank over at Tether, and that's usually not a good sign. I mean, one of the stable coins turned out to be not very stable. At least I don't have a tattoo of it, But I don't know. It looks like they're coming for Tether right now, and we'll figure out, which Chinese property developer bonds they own. But no, it's not looking good. I've been saying for a very long time that, crypto is really like the fourth derivative on rate of change of what the Federal Reserve is doing. And so when the Federal Reserve is, firing up the printing press, you want to be long crypto. And, when they're going in the other direction and they shut the machine down like they are now, you want to be as far away as possible. And, I didn't quite get the top, but I sold 58 thou. I'm pretty proud of myself. I got the meat of the move, and I'm going to reload when the Fed panics. The history of the Federal Reserve is that they raise rates until they break something, and then about 3 months later, they panic. And they're in the raising rates part of the cycle, and they're about to break something. So, it's just going to repeat again. But you don't want to own any crypto while they're in the process of breaking stuff.
Yeah, and so the cycle's still underway, and I mean, just so weak. We can pull up a chart of it when we talk some charts later on. So let's move on though, because we mentioned it last time you were on. We were talking Elon, but the story just keeps going. So this Elon Musk with Twitter, is he going to do it, not do it? Boy, he certainly has this amazing ability to stay on the front page of the news every single day, no matter what. What's your take on all of this?
He's amazing. He's the greatest stock promoter of our generation, maybe of all time. And he found a way to distract everyone from what's happening at Tesla. And there's always a distraction. Is he going to buy Twitter? I don't really know. I think he might legally have to, but he's kind of squirrely. And I assume the guys over at Twitter signed a contract that's devoid of any teeth. And I don't know, it'll be an interesting one to watch. It's funny watching the risk arbs. I mean, look, it's trading at 38 right now, and he's supposed to pay 54. I mean, I've never seen such a wide arb when you have a buyer who clearly has the cash to close. It's quite crazy.
It's certainly something. I guess the market is just doesn't believe it's going to happen. It's an amazing spread on that. But anyway, let's move on because you went to the Berkshire event. You hosted a little thing of your own on the side there. You got to fill us in. How did it all go? And did you pick up anything interesting when you were out on the trip?
Well, I mean, I drank some beers and I went into the meeting, and Buffett did the same thing Buffett's done for the 20 years I've gone. He told you to buy good stocks and go to the beach. That's what he says every time, and it's probably a good strategy. We had a meetup. A good friend of mine, Josh Young, showed up. Also, a good friend, Bob Robati, came. Bob's really a legend in this industry, and we sat down on a table and talked for 2 hours. And, we put some clips up on YouTube. They're worth watching. But we're talking about what's happening in this commodity cycle and why we think the cycle keeps going just because there's no supply coming. And, that's not just oil, which I like to talk about, or gas, which Josh likes to talk about, but also to other chemicals, hard goods, pretty much anything. They just haven't added any supply. The sectors have consolidated. The players have consolidated, which gives people pricing power. And for the first time in a very long time, these companies are making really good money. Bob aptly calls it the revenge of the old economy. And I think that's a great name because it is the revenge of the old economy. You can have this view that in cyclical industries, you kind of make money 2 quarters every decade. And I got a feeling that they're going to make money for 2 decades now. And I don't think people realize that or are pricing it in.
Right. So in all of those adventures, you ended up doing a little site visit out for one of your favorite darlings, St. Joe's. How did that site visit go?
Oh, that was great. I mean, look, the Florida Panhandle is one of the prettiest parts of America. I love going there. It's relaxing. It's peaceful. I have a bunch of friends there. It's always great to go check up on Joe because it's my second largest position. I got to spend a whole day with the CFO as he drove us around and showed us all the new projects. It's just really amazing what they're doing and the speed that they're doing it at. And, they're super high quality real estate projects. And, while everyone's talking about maybe real estate slowing, maybe it's not, I can assure you that nothing's slowing at Joe. Year over year numbers are incredible. The prices they can get on the properties they're developing are insane. And you have huge migration into the Panhandle, mainly into the part of the Panhandle where Joe's doing business. And, I think it gives you line of sight for many years of just really dramatic growth there. Meanwhile, it trades at like a quarter of NAV, which is usually a good starting point for buying something really cheap. And, after I met with management, I bought some more.
Well, the stock has certainly been under pressure, but that's largely because the whole stock market's been under a lot of pressure, and I think everything is feeling a lot of heat. But what's your take, obviously, on the whole real estate market? Because clearly you're right that there's like a demographic thing. There's movements, people relocating, so you probably want to make sure you're buying real estate in the right areas. But one thing that's always a hot topic as to whether these home builders represent some opportunity here. What's your take overall on real estate and the risk of a recession and whether the home builders are an opportunity here?
So the home builders are just absolutely hated. I've never seen a sector that's this cheap and this hated. And yeah, I get it. Interest rates are going up, and that's going to put some, forward pressure on the businesses. Like it's inevitable. And I think people are looking at this though, and they have PTSD from 2008, where you had all these low quality home buyers using funny structured finance products that got them into homes. Interest rates went up, and all these adjustable rate mortgages blew up, and they dumped homes all over the place, and home prices dropped, and then the home builders blew up because they had super levered balance sheets. And I really think this cycle is different. I mean, the home builders are in much better financial shape right now. They're way less levered. Though the buyers are, using 30-year mortgages. Yeah, interest rates are up, but if you're fleeing Manhattan, whatever you're going to pay a couple $100 more a month for your mortgage, but you're going to save more than that by avoiding state tax when you go to Florida. I think it all kind of washes and people can pay a bit more, especially, just because wages are up and, work from home lets you do this from cheaper places. And so I think you're having a little bit of a pause right here, right now. I think there's a little bit of sticker shock just because home prices have gone straight up for 2 years and mortgage rates just went up dramatically. And everyone's taking a little of a wait and see and just to see if prices drop a bit. But I don't think price is going to drop much. And I think that by the fall, everyone's going to be back to speculating in homes just because, what else are you going to do with your money? You're not going to buy stocks. Those only go down. And I think for your typical middle class person, they have most of their net worth in their house. It's a great place to be because you're funding your mortgage at 5%, and homes go up 20% a year, and you're making 15 points spread, and you get to put a few turns of debt on that, and you're making like 50 to 100% on your equity each year. Plus, you get to live in it and enjoy it. It's a way better investment than shitcoins and Ponzi stocks. And I think that people are going to take their money and just keep upgrading their homes.
Well, yeah, I think that story is bang on, but I think the bigger question is that when will the trend shift in the home builders? Because like right now they're technically under so much pressure, and the whole stock market is having the air taken out of the balloon. It's going to be hard for home builders to buck that trend until we see, I think, a little bit more of a light at the end of the tunnel of the entire cycle. So do you agree with that? Like that, even though they're cheap, that the opportunity may still be months down the road?
I'm not sure about that actually. I kind of think bonds have bottomed. I know that's a contrarian view, but go back to what I said a few minutes ago. The Federal Reserve raises rates until something breaks, and when something breaks, they panic, and stuff's starting to break. And I think the Fed's going to do 50 bips more, and they're done. In the end, they can either go fight inflation, or they can blow up the galaxy, fighting inflation, or they can declare victory and take a wait and see. And at that moment, I think all these home builders double and triple. I think my Joe, is triple digit stock. I think, Builders First Source, which I own a ton of, I think it's triple digit stock. And, they got massive buybacks in place too. When you think of the inflation, it's mostly, you had a couple steps, okay? So everyone was given stimmies and told not to go to work for a year and a half, and everyone's finally getting back to work. The supply chain's fixing. People are buying less stuff because they have less stimmy. Like that part of the financial system, the economy is healing, quote unquote. The other part is the stuff that the Federal Reserve really can't fix. Unless you're going to put cash carry out a tractor, how are you going to get more wheat? How are you going to get more corn? How are you going to get the price of oil to go down? If the world consumes 3 million barrels a day more than it produces, the price of oil is going up. And the Federal Reserve, they could take rates to 10 points. In the end, it's not going to change the price of wheat. The elasticity of wheat, I don't care what it costs. I'm going to still eat a bagel. It's just, I don't think they're going to be able to catch this. And I think the Federal Reserve kind of intuitively knows that they can't catch it. And if they raise rates too much, they're just going to destroy the whole financial system, and they're still not going to catch the price of wheat. And so I think they recognize that. And I think that as stuff starts breaking, the stock market's down 20, 25% from the highs, and a lot of the smaller stocks are down by half. I don't think they're going to push much harder. And when they take their pause, I think housing just goes bonkers, because that's the point where that 5 is the ceiling on a 30-year mortgage. And look, 5 is up a lot from 2.5 or 3, but by historic levels, 5 is pretty cheap still to borrow money at for 30 years. And so I think it's just I think the cycle is going to start pretty soon. You probably got a little bit more pain, and then it's going to go. So I want to be long these things, and I'm buying the pullback. That's
awesome. All right, so now I think back to when you started coming on to the show. It was great to have you coming on, and one of the stocks that you talked about was Sting, back then, so a lot of our listeners remember your big pitch on the shipping space. Now, obviously, you've gone through your changes of your view on that, but there's no denying that this year has been the year of shipping stocks. Like, I mean, they didn't get the memo that there's a bear market. Like, Sting's up 200% off of this year's low, and we're having the shipping space just exploding higher. Obviously, geopolitics and supply chain disruptions and all these things are driving it. What's your take on how this is playing out? And do you think that this is just still the beginning and there's more to be had there, or is this just a short-term pop?
Oh, I think there's more to be had there. I mean, if you look at Sting and you look at all the other clean tankers, in the end, you have a bunch of things at play. There's no new supply coming or negligible new supply coming. You have low inventories of refined product around the world. And because of low inventories and what's happened with Russia, which was a very large supplier of refined product, and now having to get this refined product from further away, it's coming from the Gulf, the Arabian Gulf, the U.S. Gulf. It's coming from China. It's leading to much longer voyages, and also you're having a lot of interbasin arbitrage. And so clean tanker rates, especially on MRs, have gone to decade highs. And I think they're going to stay here for a while because there's really no new deliveries expected for 23. 22 is in the bag. 23 is almost in the bag in terms of what the order book looks like. And so unless they start ordering, even then it's 24 when new supply comes. Meanwhile, refined product inventories keep drawing down every month. And if you keep drawing down, eventually, people start scrambling for inventory. We had a panic in diesel on the U.S. Coast. The East Coast ran out of diesel effectively. But you have these sort of situations where people panic and they pay a lot for vessels because they need it. And I think the clean tankers can do well. I don't own any Sting, but I own a lot of Torm. I mean, I've basically doubled my money in like 2 months. It's good for me.
Yeah.
I think it's going to keep going.
How about the dry bulk shipping in other areas like that? Do you follow any of those other types of names?
Yeah, I follow. Dry bulk's doing very well. The question with dry bulk is just what the global economy does. If you think the Federal Reserve keeps tightening and blows everything up, and you don't want to own that. If you think the Federal Reserve takes a pause pretty soon and the Chinese reopen, then yeah, it's going to keep doing well. You've seen all the bottlenecks have been great for containers. I mean, those guys are still printing money. The box companies like the Tridents, they're doing amazing. It's the revenge of the old economy. People stopped investing in these things because they were just losing money when they added supply. And for the first time, you're making money. The only thing that's really not working is the really large dirty tankers, and you still have some deliveries expected, and OPEC can't hit their numbers, so there's not a lot of seaborne transport. But I think that's going to resolve itself soon as well, just because you have new mandates for environmental mandates, and I think it's going to obsolete some vessels, and there'll be a bit of scrapping, and I think it'll heal itself pretty soon, and even the dirties will do well. It's probably a 23 story, not a 22 story, but I'll be hunting around there. I mean, if you look at what's happening where Frontline and Euronav and International Seaway are all doing this three-way merger, I think consolidation is very good for pricing. And John Fredrickson has a long history of making money. So I have a funny feeling that's going to be good for the whole ecosystem.
Now let's talk about some commodities. Now I'm not going to bother to ask you if you're bullish oil because I think everyone knows. but one of our listeners on Twitter asked the question, and I thought it was worth asking on their behalf. But it's like, how, in your mind, if the Fed does cause a recession or an economic slowdown, how much, let's say it hurts demand a bit, how do you feel that that's going to impact the story, or does it not matter because the demand destruction it just doesn't matter relative to the supply constraints?
So, I mean, people keep talking about this demand destruction thing, but it doesn't actually exist. It's like an old wives' tale. Like, look at some of the craziest moments in the history of oil. Oil goes crazy high, like in 2008. There really wasn't any demand destruction. And then the economy collapsed 6 months later, and you had 2 quarters of negative demand, and then it just came roaring back. I mean, in the end, you have 6 billion people that want the same standard of living that a billion of us have in the West. And many of these people, they literally don't have air conditioning. They don't have refrigerators even. Like as their consumption of energy increases on a per capita basis, the demand for energy is unstoppable. And these people are going to continue to have their economies grow. In terms of oil, I'm not good at guessing every little squiggle. That's not the thing I do. I own 25 oil. I own some 23 oil. I own some call spreads. I own some calls. I own a ton of deferred contracts because here we are, and oil's been above 100 for a while now, and still no one's spending any money to produce oil. And if demand is going to keep growing 2 to 3 million barrels a year, I mean, 2 to 3 million barrels of new supply has to come. And I think we're in a world where the supply side is flat at best, or maybe even shrinks by year end. And I think next year it doesn't look very much better. And so, I mean, where is all this oil going to come from that people are going to need because the demand's going to keep growing? I mean, you're a market guy. I'm a market guy. The thing I've learned doing this for over 20 years is that when they throw a lot of bad news at a market and it doesn't go down, that's really telling you something. I mean, look, we're draining the SPR, 1 million barrels a day. China's locked down. All sorts of other stuff has happened. And here we are where, the stock market's crashing, CTAs are liquidating. Like they've thrown everything they can at the product. And oil's not backing off one bit. I mean, the SPR is going to run out of oil soon, and China's going to reopen one of these days. And I think it's going to go absolutely screaming. I got a funny trade, and don't cry to me when it doesn't work. But I put on the 200, 250, 300 butterfly for a DC of 22. It cost me about 25 cents. I don't think it's going to go out quite at 250, but I got a feeling I'm going to get paid on this one. I mean, it's priced like there's zero chance of that butter hitting. And I don't know. I think there's a fighting chance, let's say. Not quite 50-50, but it's not a bad option. And I don't know. What do you think about that, Patrick?
Well, you know what? I think that's a really interesting call. Like, we'll put up the oil chart when we talk some charts. But you're absolutely right. It's what's amazing is that while we've seen so many commodities pulling back and so many things getting hammered, but energy ain't one of them. And oil's been perpetually, doing higher lows. Just every time it dips, people are buying. The interesting thought that I have, though, is that wouldn't it be interesting if we saw just simply the backwardation flatten a little bit, where you're right about those longer term contracts, but if there is a little bit of a short term recession scare that can cause the front of the curve to kind of back off a little bit, but it may not hurt your longer contracts, right?
I mean, my longer dated paper has like zero delta. It just doesn't move. It will. It's kind of like walking its way up the curve. I've had them on for almost a year now, and they're in the money. They're doing well for me. But on a day when oil drops $5, they don't move, and a day when oil is up $1, they go up like a nickel or a dime or whatever. They're kind of just walking up the curve with zero volatility. I think what you're seeing, and people keep saying, "Hey, Kuppy, why are they not drilling? Oil's 110," and I say, look at where it is for 23. It's at 80. Look at it in 25. It's 70. You're going to go drill a well, and that well used to be break even at 50. Now it's break even at 70 because all your oil field services costs have gone crazy. There's inflation in everything, not just the price of oil. It's steel and all the downhole everything. So if it's going to cost you 70 break even, and you go to hedge this thing and you try to hedge out along the strip, I mean, you're locking in no profit. Why go through all the brain damage of drilling a well if you can't make money at it? So until the back of the curve starts moving, there's zero incentive for anyone to actually go out there and add supply. And I think this is going to naturally lead to an energy crisis. And, my view remains that the front of the curve is going to overshoot to something stupid, call it 500 or something, and then pull back to say 200 and find its new home. I wrote a blog post about the new levels, and I was talking about how lumber, overshot and came back to a new level, and it's not going back to 300. And I think oil is going to overshoot and find a new level, and that's a triple-digit level, I think. And I don't know. I just want to be as long as I can energy. I have a massive possession, and it's been doing well for me, even when the rest of the market's detonating.
Now, you specifically like to play the oil itself, but do you ever comment or look at some of the actual energy companies? Because it's an interesting storyline in terms of, let's say, the oil service stocks, because they've been left behind compared to a lot of those fully integrated oils, and a lot of these other big energy names have been running. Well, I mean, I guess Schlumberger and Halliburton have moved obviously in the last little bit, but nowhere near over the last 2 years of equal magnitude to some of the other energy stories. Do you think oil service comes back in a big way at some point?
Well, yeah, I mean, but it only comes back when people start exploring for oil. It's amazing that oil is at 100 and the companies are making some money and they're still not reinvesting. But it's going to work, because eventually, if I know anything about oil men, they make too much money and then they blow it all drilling holes. And I want to own this stuff that's going to make money when they start drilling holes. I mean, I own some, fluids. I own all sorts of stuff throughout that ecosystem. But what I mostly own is offshore, because if you look at what's happened over the last couple of years, all the big discoveries have been offshore, whether it's Brazil, Guyana, Suriname, West Africa, like all the big discoveries are offshore. I think that when you look at the spending over the rest of this decade, I think it's going to be done offshore. It's a lower cost. It's long cycles. So you have to be confident in what the price of oil is going to do. But you also avoid all this ESG nonsense. Think Suriname cares about their carbon emissions? No, they just want dollars. They're a country that needs money. So I just think that they're going to welcome these guys, whereas Biden's going around kind of this whack-a-mole of canceling contracts and banning pipelines and just making everyone's life hell. Suriname and Guyana and Brazil, they're just like, come over, come. And I think that's where the spending's going to be. I own, Valaris. Look, it's almost a triple since I talked about it on the show when it came out of bankruptcy. I think it's a 10-bagger from here. I own a bunch of Tidewater. It's almost a triple for me. I own a bunch of these things, and they've done very well. But you're still buying a bunch of equipment for 10, 20 cents on the replacement cost of the equipment. And at the top of the cycle, historically, these things go for 2 or 3 times replacement cost. And from 0.2 to 2 times a 10-bagger, like it's a good place to be, and they might even pay me a dividend along the way.
All right. Well, you know what? I was waiting for this pullback in oil and energy stocks to buy the dip. They didn't really give it to me, but the one space that has given a pretty interesting buy on dip is uranium, and the pullback here is far more distinct. Is your bullishness toward uranium still the same? Your resolve still there?
Oh yeah, absolutely. I mean, the story keeps getting better. Every month, a few million pounds of inventory are consumed. It's mainly getting consumed on the balance sheets of utilities. They're draining the warehouses slowly, and one day they're going to run out of pounds. Clearly, there were more pounds than I expected. Whoops. But I think what we've seen over the last couple of weeks is that it became a hedge fund hotel. Every wise guy hedge fund thought they were going to squeeze Exelon. And in the end, there's enough pounds. And so they all bought Sput. And when it didn't work, they all dumped it. And Sput collapsed. And but it doesn't change the long-term view. And I still own mine. I added a bunch in this dip. I've never sold any. I think it's going to work out just fine. The world's going to transition to uranium as a quote-unquote green source of energy. We just learned that in California, they're not going to go shut down their nuclear plants. Like one by one, we keep getting better data points. And one day they're going to run out of uranium and the price is going to go crazy. And I don't know, my timing, I don't know. It's going to be a volatile thing. I've been in it 6 months. It went up a lot. It pulled back a couple times. I think it's about to turn again.
All right, Cup. Well, I'll tell you what. This is a pretty good hit for the Cuppy's Corner, but I think we can continue this conversation over talking some charts. So why don't I pass you over some crayons and let's do this. You want to talk some charts with me?
Yeah, absolutely. Let's put up Sput to start with, if you're okay with that.
Well, Definitely we will. But what I want to do
Okay.
is, before we do, is talk about the top 3 things to watch, because this is like a thing we do here. So what I wanted to just highlight quickly what Kevin and I were looking at last week. And we were looking at the high yield credit spreads as to whether or not we were going to see that trend continue of them widening. And what is interesting is that the credit spreads continue to stress the market. So like here, we have on high yield corporates, we're at 4.92% now, making a fresh high. And what we continue to see is the trend where while treasury bonds have clearly started to show that they may have bottomed, like you were even suggesting, there still continues to be huge amount of pressure on those junk bonds. And it'll be really interesting to see where that trend continues. But certainly we were watching that, and that trend has continued. Do you have an opinion on those credit spreads?
Yeah, they're going to keep blowing out. The Federal Reserve always breaks stuff, and they've told you they intend to break stuff.
There you go. Well, listen, this number 2 was the U.S. dollar. I had to always throw that in there. But what is actually really interesting to me with the U.S. dollar is that at least for the last week, it stopped going up. So even though the stock markets remain under stress, and there's a lot of these this kind of anxiety about what's happening in the markets, the dollar, which was ripping higher throughout March and April and being one of the focal points in all of this, really has paused. And we were asking the question as to whether the trend could continue or whether it was going to be a prairie dog. And it looks like it may have prairie dogged that little breakout there. And maybe the dollar is starting some sort of a short-term break. Do you have a call on what you think is happening here in the dollar?
Well, I saw Brent on Twitter doing a victory lap, and that's how I just knew it was going to pause.
Well, you know what? It's the moment it's a bizarre thing. The moment you go and see these guys on every major show, it's because the topic is so hot. They want to bring someone to explain it. And when you just see headline after headline of these people coming and talking about it, you just know that the trend is very mature. At least the short-term one, technically. It will be really interesting. To me, I still think the dollar can remain bullish if it stays above the 100. It's a nice, clean, round number. The fib zone lies down there. Sure, we could pull back for a couple weeks or a month, but I don't know whether I want to be ballsy and make a call that that's it for the dollar move, but it's certainly run its course. The interesting thing is when you look at that euro, I remember that 2020 period where I lost that stake to you. Oh man, that still stings. But you made that call back then that the euro was going to rip to north of 115, and you were bang on, and I had to buy you a nice big steak for that one. But do you have a call here? Do you think the euro can? Is the worst really been baked in as this has now come back to 2017 low? I mean, is there more downside on the euro in your mind?
Yeah, I think so. I mean, it's funny when Russia first invaded and the ruble went to like 130. I was joking that I thought it'd go to parity with the euro. And pull up a euro ruble. I think it's still going to parity with the euro. In the end, Europe's short energy, and all the capital is going to just flee that place in sorts of energy because they're short. They shut down their nuclear power plants. They shut down all their coal, everything, and they're screwed. I'm going to Europe this summer. It's going to be very cheap when I get there. I'm excited for it. Maybe we'll be 85.
Maybe. And so the number one thing we were asking was whether or not the stock market was going to put in a short-term bottom. And, well, you know what? It didn't really break to a lower low, but it certainly hasn't rebounded. We are in option expiration week. The OPEX is always a tricky period because the dealers are jammed up with so much gamma that it creates all sorts of wonky volatility. But it'll be really interesting to see whether some short-term relief rally emerges in the stock market here on the short term. But right now, I don't know, would you think that's close to a short-term bottom here, or you think there's more downside?
Oh, I think there's more downside. I mean, look, they plugged the 3,900 strike just right bang on. But I think there's a lot of guys that are really wounded. I think there's a lot of guys who have a lot of redemptions. The Fed's out there threatening another 50. No, I think it's going to keep going lower. It's going to keep going lower until the Fed cries uncle.
Yeah.
And I don't know, maybe they'll have a couple bounces here and there, but it's going lower.
Well, this is you said it right there, which is I actually think that the market's ripe for a bounce now, and I also believe that this is not over. And so I'll agree with you, but I think from a technical perspective, with us now going into next week and the gamma roll off being done, if the market wasn't going to tank this week, there's a chance that we get a squeeze. Now, I remain in this cycle negative. I think that the market still could be 3,500 or lower easily, and when we go a little bit later past into the summer. But I think that a short-term low on the stock market may be in play here, and it'll be one of the things I'm going to be watching early next week. Anyway, so let's talk about the three things that I wanted to watch next week. And number 3 was consumer staples. And one of the things that we have seen throughout this bear market is that tech names were having their faces ripped off, and the safe haven was completely in defensive names. Whether you were in utilities, whether you were in the consumer staples, whether you were in a select number of healthcare, there were places to hide. And this week, that all unraveled. This is the XLP. The consumer staples suddenly joined the party. In fact, this is probably where almost all the selling occurred. Many of the tech names weren't having their faces ripped off this week. It really came in from, the Walmarts and the Targets, right? But all of them, whether you look at the drop in Coca-Cola, you look at the selling in Procter and Gamble, obviously, like I was saying, Walmart got just clobbered, and then Target it was just gross gaps lower, almost to the magnitude of when Facebook gapped lower that many months ago. But what's your take on all of these retailers and all of this consumer staples finally getting hammered here?
Well, it's all kind of expensive. There's all these stocks, the compounder, quote unquote, names, like the Ross stores. Yeah, it's a great business, but it was always really expensive. And, pull up a chart of Ross. It took out it's back to pre-COVID levels, which is kind of ROST. It's kind of crazy when you think that it took out pre-COVID levels because, they made a fortune during COVID. The balance sheet got fixed. They have all this cash, they did buybacks and everything. But it didn't matter because it was overvalued. And it's one of those things that, hedge funds were hiding in. Hedge funds had all the FANG mat on, but they're also hiding in these other value names. Look at John Deere. The numbers I thought were fine today, but it's another, compounder. Yeah. Everyone's like, oh, let's go hide there because of agriculture. I want to be long corn and wheat, but I don't want to be long corn and wheat itself. Let's go buy some Deere. Well, it got obliterated. You basically don't want to be in anything that hedge funds own because they're all getting redeemed. And, I think it's time for these sort of things that were expensive to get hit. And they're all getting hit now on, some of them are meeting estimates or they're sort of meeting estimates. I think people got really excited by inflation because early in inflation, what happens is the revenue number grows and everyone gets excited because everyone loves revenue growth. And then later on, people realize that margins get squeezed because inflation sucks. And we're at that part of the inflation now.
Yeah. The part that I find scary about that is that the one thing that was making the entire stock market sell off up until now much more orderly, it was a very distinct sector rotation, right? They were selling the dog shit. They were going and hiding in higher quality names, lower beta names, and when you get a real shit show stock market sell off, it becomes that scenario where the correlation of everything goes to one and they just dump everything and there's no nowhere to hide. And
Yeah.
and I think that with these types of stocks starting to get hit, this is now hitting those people that have been able to successfully hide for the last 6 months and been laughing that, ARK is down, 50 to 70% and they're still up on the year. But suddenly in the last month, that story has completely changed, right?
Right. I mean, look at John Deere. It's down by a third in like 2 weeks. I mean, that's
Yeah.
supposed to be a low beta, safe name. In the end, the only place you're going to be able to hide is oil, because when oil does the blow off, it's going to wreck everything else in the galaxy, and oil's the only place you can hide.
There you go. So the number two thing to watch was Treasury bonds, and I know you mentioned it, and I was like, okay, I'm going to just let him say it passively because I thought this was a great conversation to have. But it really does feel like the big bond bear market has taken a break. I'm not ready to be bullish bonds outright yet, but the one thing that we can say is that bonds, when you look at this 10-year note, we're trading at the same price level we were at the start of April. Right, like the selling has stopped. It's much more of a sideways chop, and things are grinding, but bonds have really taken a break. And the bigger question is if there is truly going to be some sort of an economic slowdown style recession, will bonds have a safe haven trade element to them that nobody is right now willing to stick their neck out for?
Yeah, I think so. I think the Federal Reserve will basically cry uncle and say, we don't control the price of oil and corn and wheat. And they're going to hedonically adjust it and blame Putin, and they're going to let bonds roar. And I think we're probably past the turn, and I think bonds are going to do okay here. I know it's a very contrarian view. I mean, everyone hates bonds, but I think it's going to come out okay.
Well, okay, look, bonds rallying is one thing, but are you ballsy enough to think we're going back to zero rates type of thing?
No, I don't think we're going back to zero rates. I think rates are going to go higher the rest of the decade, but I think the Fed's going to take a pause. I mean, you have guys, uber doves like Kashkari and Brainerd that are out there talking about Paul Volcker as their hero. Like, that's scary stuff. And so, it's out of character for them. So, I think it's spooked the market. You have guys talking about 300 and 400 bips, and I think they're going to stop somewhere in the ones or twos and take a real pause and see what happens. And I think bonds will find their feet and bounce a bit.
All right. Well, you know what? I knew you were coming on the show, so I had to put number one as crude oil, buddy. And
It's the sexiest chart in finance.
yeah, and so but particularly from a technical perspective, I want to highlight one of the characteristics I look for is the pattern where dips are being actively bought. And the characteristic of higher highs, higher lows, and generally that there isn't active and heavy distribution. And think about it, the whole market, including many commodities, like including uranium and including Joe's as a real estate, everything's been under selling pressure. But yet, here, let me pull out a thick crayon. There's a very distinct pattern of higher lows as this is working in an upwards channel. And this entire last pullback that we saw right here this week, while it did throw back, like $8+ in a few days, it immediately got bought on dip. And here we are, trading not far from the high end of the week. And
Do they call that the handle that comes out of the pennant? Because I see a nice triangle,
yeah.
and then I see a little bit of a pennant kind of building there. I don't know. I'm not a crayon guy. Yeah, you're doing it exactly that.
Yeah, and you know what? The point here is that there's only one obstacle standing in crude oil's way. It's previous high. And there's always the risk that there could be a double top or something like that. But you're bang on that the fundamentals are there. And you think about it. All of the stuff that could have hurt crude oil, including the fact that China shut off its economy and all these things, and crude oil never sold once. And here we are trading near 52-week highs, boy, if crude oil makes a fresh high, it's going to be hard to stop it. It's
Yeah,
I
look,
mean, this could easily be, using the rule of symmetry type thing. We could easily have a punch to 140, 150 by this summer if this thing breaks to new highs. Now, I'm not making that call yet, but right now, this is the thing to watch. We are trading right to those highs, and if it breaks to 52-week highs, it will be the headline on every news station, and then the FOMO chase is going to go on, and it's going to be a self-feeding loop that's going to just keep driving this in a squeeze because it's the only place to make money.
I mean, I think you should look at what's happening with commitment of traders. I don't know if you can pull it up, but I mean, the COT shows no one positioned. Specs are not long. Specs just keep taking down their open interest, which is part of the reason it's whipping around so much. Just there's less players, but
I
this
just
doesn't
here
have
I
all
just
the
pulled
spec lanes
I
like
pulled up this
uranium.
one. Is this the one you like to look at? I don't know. This is the COT
Good
report.
enough.
It's good enough, right? But it hasn't budged really.
Right. So, I mean, let's go back to my butterfly. I mean, the real risk is that we blow out the top of the butterfly at 300.
Well, look, it can. There is definitely the one thing we know, which I don't know about the top of your butterfly, but can this thing punch to 200? I mean, it's a pretty ballsy call you're making, buddy. I mean, look, I can't say that it can't happen, but that's a pretty far distance. But the one thing we know is that when shit goes parabolic, it don't quit. And it always shocks everyone how far it goes and how fast it goes. And I think the one thing to really kind of tell is whether or not this starts gaining momentum at new highs. Because if we start seeing $5, $10 up days when it's north of 120, you might be right. Like at that moment, it'll become like a self-feeding monster, and it could just keep going, right?
I think the best template is European nat gas prices. I think crude oil is only 6 months behind.
Right. And so it'll be interesting to see. All right, so that's those are the top three things to watch. I wanted to just go back to this S&P chart here for a second here, Cup, and what I wanted to just simply touch on here is the idea of what it would look like if we did have a short-term bounce, right? And the one thing that we saw today was an attempt to break to a lower low. Typically, especially at a level like that, a break to a lower low would feed a feedback mechanism of selling that would actually have created easily 100 or 200 point downdraft. And instead, it kind of poked its head down below that previous support line and recovered to be flat on the day. And that to me is kind of showing a market that's exhausted of selling. I think that it's a very reasonable chance that we have a squeeze, like maybe not of the magnitude we saw in March, but these types of kind of reactions on the upside of the market where there's too many people short, too many people flat, too many people being margin called, and then when you do is you just have one reaction up, and everyone's like, oh my God, the market bottoms in, and then they all panic buy and create the reaction the other way. It would be really interesting to see if we get going into June one of these kind of 300-400 S&P point snapbacks. Now that wouldn't in the end be a new bull market, but it would certainly be something that would squeeze out a lot of shorts that are so sure that it's all downside from here.
Yeah, I mean, anything's possible. Haven't you heard about monkeypox? I don't know. I don't have a super strong opinion in the short term on this one. I think the trend is down. I mean, if you look at it on a bigger chart, it's just a giant head and shoulders, and it's sitting below all this overhead now, and it's just a giant 2-year distribution. I think we're going down, but yeah, it could do almost anything in the short term.
All right. Well, let's talk gasoline futures, and I'm looking at the RBOB here, and what's interesting is that gasoline has been breaking out. and old dips are being bought, and it's amazing. But like the crack spreads are like $48. Just unbelievable that this trend is so strong. It almost looks like gasoline is a stronger trend than oil itself. Do you have an opinion on gas?
It's all going higher.
Well, they're correlated. I get it, but you still have the preference in the crude itself, right?
I just like the crude oil itself. I keep it simple.
The most liquid market in the world, right? Like one of them, anyway. It's the big boy in the room, right? The interesting part is precious metals getting a little bit of a bounce, but to me, gold I think has been behaving very much like a cross currency to the dollar. And obviously, the euro's bouncing a little bit here, and it's no surprise that gold is too. But I wonder whether that's just going to be the story here. It's like, well, if you're right and the euro is going down to 85 cents, well, at least that was I don't know whether you're serious about that call or joking, but if
I'm hopeful.
hopeful, there you go. Oh, hopeful is not a market call, but anyway, one way or another, I mean, if we saw euro breaking down to parity or lower, I wonder whether or not that kind of dollar strength just keeps a lid on gold and keeps this just grinding. I sort of, I know that you call Joe's your gold holding, but I still think that the gold has a role to play. And but the reality is that if fighting that kind of a dollar move, at least when you're valuing gold in dollar terms, obviously, there's no shortage of people now talking about, gold as it's priced in all the different currencies and how it's pressing higher. But really, I think, we analyze gold in US dollars, and this really does continue to be a grind on the charts.
Yeah, I mean, I think it's just range bound. I don't really get excited about gold. I mean, when it started breaking out, I was smart enough not to chase it, thank God. I have this view that a lot of what's happening right now is you have these risk parity funds or 60/40 funds, whatever you call them, and they're loaded up with tech crap like FangMat, and then for their bond proxy, they saw inflation coming. Instead of owning 30-year to hedge it, they bought a lot of gold as like a bond proxy because it's supposed to be inflation protected. And so as these guys degross because their equity leg is just getting obliterated and their bond leg's getting murdered, they're forced to sell down their gold. And I think that's a lot of what you're seeing here in terms of overhead. I mean, obviously what's happening with the US dollar isn't helping. Neither is what's happening with bonds. But I just think you have a lot of risk parity funds that are just choking right now, and they're choking on gold too.
Yeah.
So yeah, I'm not doing anything here yet. Honestly, I'd rather just buy Joe.
All right.
I think it's a better form of gold.
Well, let's touch on some nat gas futures here very quickly on this chart. But I know Josh likes to mess around with this one here. But look, it had this big sell off in May, just from $9 down to like 6.5 in 2 days. It just looked like the party was over, and it just got bought on dip instantly and working its way right back up to the highs. Do you think that this just stays in trend with the oil and gas?
Yeah, but I think nat gas has a real strong potential to catch up with European pricing. In Europe, it's 40, 50, 60, whatever the price is today. And I think U.S. nat gas catches up with European gas.
Wow.
And I don't think anyone's prepared for that.
That's a pretty bold call, buddy. I never even thought about the possibility of that, but if that
well,
happened...
there's two ways that happens. There's the arbitrage because we're using these LNG tankers and moving our gas over there, which is a pretty schlocky way to move gas. The better way to move gas is BASF, the big German chemical company, basically shut down.
Yeah.
We're going to produce all these chemicals here in the United States and use our gas. We don't have to liquefy it and transport it across the ocean. And so the call on U.S. gas production is going to increase dramatically from here because there's a huge arbitrage versus the cost to produce chemicals in Europe. And I just think that that arbitrage will get closed, and it'll happen quite fast because there's really no drilling here in the U.S. still. I can't believe we're at 8 and no one's drilling, but there's just not.
Yeah.
And if you don't have the supply growth, but you have the demand growth, I think that gap's going to close, and I don't think anyone's ready for that either. In the end, I think I like to say oil is the wrecking ball that murders everything else, and I really do think oil at 500 just detonates everything else in the stock market, and I think that gas is going to be there too.
Yeah. All right. So let's leave it with one last chart. We'll talk about that uranium, the Sprott Physical Uranium Trust here, and this is where a buy on dip has been offered, as unlike the energy markets. Obviously, this thing has shaved off 25% of its value in about a month, but coming to some pretty key support lines during the last bull breakout back in 2021. It consolidated and created all of its lows in this kind of $13 to $14 area. Obviously, we're looking at the one that trades on the Toronto exchange, but I'm curious as to whether or not that's going to be a support line that holds and creates that buy on dip. Especially, I think it was Kevin that was highlighting that it's selling a pretty good discount to its NAV. What's your take on this? You think the support line holds?
Yeah, I mean, it pulled right back into a breakout. That's just textbook charting. You had that big symmetrical kind of triangle thing from September to February. It broke out on some pretty big volume. It pulled back on some light volume. I think, guys are going to buy this pullback, and this is a lot of hedge fund liquidations, and it's going to keep trending higher. I think it's a great time to own it, especially because it's a discount to NAV, and I bought some. I like it here.
All right. Well, listen, Cup, I wanted to thank you for pinch hitting and taking Kev's spot for a much needed day off that he needed. And it was appreciated. We're having this piss up, and boy, it's so much sadness from everyone that you're not going to be there. But yeah, I'm going to need a commitment from you that the next good piss up that we have, that you're going to do your very best to make it out.
Yeah, absolutely. I still don't think they allow me in Canada. But
well, your reputation has preceded you, buddy.
I think I'm like 5 to 7 boosters behind. But if we do a piss up in Miami or we do something in Puerto Rico, I'd be happy to join you guys. It'd be good. And I hope you guys have fun up at your piss up. And Lena, make sure Patrick gets home.
All right. Well, thanks a lot, Cup. Have yourself a great weekend, buddy.
Hey, thanks a lot, man.
Oh, thanks for tuning into the Market Huddle. We appreciate you spending the time with us. So please give us a follow on Twitter at the Market Huddle. And otherwise, please, if you could, rate and review us on iTunes. It helps us out. It's a silly game, but anything to improve our exposure on the markets. Otherwise, thank you all for listening. You can never have too many friends. Bear market, bull market. We're just happy to spend some time together in this crazy ride. So, stick around for a brief little after show here. Lena, hop on.
We need Kevin back.
Yeah, no guff. Like I totally. Kev's so important to the show. Like
you just don't know what you're missing until it's gone.
Exactly. Anyway, but I gotta rate this beer.
Yeah.
At first I was like giving it all sorts of things, but this is a very average IPA. You know what? I'm not going to shit on this beer, but I can't give it higher than a 7.5, so I'm going to give it like a 7.1. I
mean, at 4%, you need almost 2 for 1 kind of situation. Yeah, no,
and but that's good because, like, sometimes you don't want to have the beer hit you so quick that it's like I learned that lesson drinking port wine out here in Lisbon. It's 20%, right, versus the typical wine, and so you suddenly go and have a couple glasses of port, and you're like, whoa, what the heck is happening here?
Your alcohol tolerance has gone way up since you've relocated.
And that was what happened to me many years ago when I had a couple of these like 7-8% beers. You're just like drinking them, and suddenly, that escalated quickly. but at 4%, you can start a little slower, and you don't have to be drinking that kind of Bud Light tasting stuff, right? So anyway, it's good for what it is. I'm not going to shit on it, but anyway, yeah, it's. What else is there? It's going to be such a great time.
Are you going to share with our loyal listeners that have listened all the way to this point what you're doing this Sunday?
This Sunday?
Yeah, this Sunday.
This Sunday. What am I doing this? What am I doing this Sunday? Oh yeah, that's right. Thank you for.
Hopefully you didn't forget.
I totally did forget. No, we're gonna do a special webinar on repair strategies, and so if what we're doing is we're talking about the option strategies on how to fix stock positions that you're down on. Anyone who wants to join the free webinar, you can go to bigpicturetrading.com/trade repair. That's a free webinar, no strings attached. We're going to spend an hour on Sunday at 11 Eastern to just talk about the strategy and all the cool shit you could do with it. So if you want to enjoy that, please do sign up and join me on that. Is there anything else I was supposed to mention, Lena?
I think that's it. If you really enjoyed that webinar, you can also sign up for the 14-day free trial at Big Picture Trading.
You're so
Kevin's
awesome.
Not here. We gotta plug our stuff.
It's going to be so much fun at the Piss Up, though, right? Like
that's right.
So many people have responded that they're coming, so it's going to be such a great opportunity to meet so many of our listeners. I'm so looking forward to it. But it's like a good dust up. It's a piss up. It's going to be
on a Wednesday evening. It'll be
on a Wednesday. Yeah, no, like do not make plans for work on Thursday.
Take a day off of Thursday. Make sure you have a good explanation for your wives and girlfriends.
Yeah, there you go.
Come out to have a drink with us.
All right. Anyway, let's wrap it up from there. But have a great weekend, Lena, and thank you everyone for listening. And we'll catch you all next week.
Have a great weekend.